Okay.
Okay. So last class we had discussed 4 chapters of the life insurance module, right?
Yeah.
Okay. So I just wanted to quickly ask a couple of questions just to check the understanding, and then we'll move forward with the next 4 chapters. So Ankur, I have a question for you. If you have to explain the difference between universal life and term life to a client, what will be your high-level description?
I'll try taking a stab at this.
Yeah, please.
So, universal life would be, it's a non-traditional life insurance policy where you pay a certain monthly premium. A part of it goes for your life insurance, and a part of it goes towards investment.
Very good. Yeah.
And the term insurance is more traditional, where you get yourself insured for a particular term, and the beneficiary gets the proceeds if anything happens during that term, and it ends there. That's super high level knowledge, to be honest.
Very nice. It's very good, actually. Like it's very brief, but it's exactly to the point. That's amazing. Arpana, anything to add there?
नहीं अभी नहीं.
Okay, no problem. So exactly as Ankur mentioned, so like there are so the money is going to 2 different directions. So one portion of the money is for the insurance itself, which is like covering the cost of your mortality, and the other portion is going towards investment, and that investment keeps on growing with time. So that growth of the money, that may actually be taking care of much of your premium in future. Okay, so that is a big difference. And the other difference is that term life, once you finish a term, then you have to again go for a policy, and the rate will be revised. The rate usually becomes much higher. Okay, whereas in the universal life, you are you are deciding a contribution, and you are keeping that for a longer term. You can change that. There's flexibility in the universal life where you can contribute more amount or less amount up to a certain maximum and minimum. Okay, so universal life has more flexibility, and also universal life has a flexibility of like a choice where you want the money to be invested. Okay, and that is the difference between universal life and whole life, because whole life is also permanent insurance, but in whole life the choice of investment is not with you, it is with the company. They will make the investment choice. Okay, so and usually they are on the conservative side. Okay, so as one example, I hope you can see my screen, right? Can you see my screen?
Yes.
Okay. So if you go there, so this is Equitable Life of Canada. Once you have the advisor login, you'll get access to this area, right? So here you can find very useful information about the difference between the the policy types. So as one example, let's say let's say this one, which kind of life insurance is good for you, right? So here, see, term insurance is like renting an apartment. Most people have rented at some point in their life. You pay your rent, but you'll never own the apartment. Depending on your situation, this can be the best or only option of the time. If you decide in the future to purchase something permanent and move into your own home, you don't take any equity with you, right? So that is term insurance. Term insurance, like renting an apartment, you are not like you are paying for using that the benefit, But
Yeah.
once you finish your term, you are not carrying anything with you. There's that you forget everything that you're done, right? So similarly for term insurance, you paid for that duration, you had coverage for that duration. Once term is finished, you have nothing left there. You start again from scratch or fresh. Permanent insurance is like owning a home. It's not just about meeting an immediate need, but also about investing for your future. It may be more expensive than renting, but you build equity with every payment you make. Plus, if you put money into the house through upgrades and renovations, you can further increase the value, right? So that is the difference. So when you're comparing, you're saying term insurance cheaper, permanent insurance higher. Of course, it will be higher because this is coming with a guaranteed benefit whenever you're passing away, irrespective of when, right? And you have more features. You have investment value, residual value, and those things. Okay, and these are some of the things which you should be considering for term and permanent. So these things we can go in a bit more details later on that one. And then within the permanent insurance, there are two types: whole life and universal life, right? So universal life has more flexibility, whereas whole life has less flexibility but more guarantee. That is the main concept that you have to remember. Okay, so far so good, right? Anand bhai, you okay?
Yes.
Okay, so I will ask you to just go through those chapters again and be clear about that. And then let's go into next section. So we're done to chapter 4 there, right? So now let's continue chapter number 5. Okay, so riders and supplementary benefits. So what is rider? Rider is an extra feature on top of the basic policy. Okay, so they are supplementary benefit. Okay, so riders provide additional benefits upon death. Supplementary benefits provide benefits before the death of the life insured. So riders and supplementary benefit, they're similar, but rider is coming into basically that's giving the benefit after the death. Supplementary is due before the death. So that's the only difference. But otherwise, these are all additional features. So one example is paid up addition. So so paid up addition is what? So paid up addition is if you have for example whole life policy, you are having money accumulated in that, right? You may be getting a dividend in that, right? So using that dividend, you can actually buy some additional insurance. Rather than withdrawing that money in cash, you are saying that okay, insurance company, you keep that money, and instead of that, in lieu of that money, give me additional insurance. They may give you it's on top of the $500,000. They may give you another $20,000 for 2 years or 5 years or 1 year, right? So you're getting some additional benefit for a certain duration. So and you're paid up for that. You don't have to pay additional because you already paid that through dividend. Okay, so that is paid up addition rider, and you do not have to give any additional evidence. So you increase your policy from 500 to 525, you do not have to give another health check or anything, right? So it's automatically getting added. Okay, so that is that concept. Then term okay. Term insurance rider basically would be where you are with some additional money, you are buying additional insurance for a limited period. So you may buy for next 5 years, I want to buy additional $50,000, right? So that is a term insurance rider. You can buy some additional amount, so that also you can include in your policy beforehand. Okay, so that is a term rider. And then family coverage rider is what, just as the name suggests, as a policy holder, I can buy policy for myself, but if I have family, I can add some coverage for family members, right? So you'll also pay additional cost, but you are taking the policy coverage for your spouse and for child as well. So it is sold in unit, meaning $5,000 is 1 unit. So you can say that I'll buy 10 units of coverage for my spouse, and I will buy 20 units for my children, right? Each. So that way you can add additional coverage for your family in the same policy. Okay, so that is the family coverage rider.
Okay.
Okay. Yeah. So I'm just giving a high-level concept. I'm not like going into like fine details of these things, and I think you don't really need to go into too much of fine detail because this is an open book exam, so you can easily like if you once you understand the concept, like it's a matter of just control find, and you can verify the answers with while answering in the exam. Yeah, and
yes.
yeah. Okay, converting child of family coverage rider. So whenever you see the word conversion, that basically would mean that you're converting temporary insurance to permanent insurance. Okay, so here you may have bought a coverage for 10 years, and if you have bought this rider, converting this you have this feature converting these riders. You are saying that for your family, spouse, or children, you are converting that into a longer term permanent life insurance. And they don't have to pay additional, like, and do additional health check. Okay, and similarly, accidental death rider is what? So usually many companies would allow this thing that like my basic death coverage may be only $500,000, but they would allow you that if the death is caused by an accident and you bought an accidental death rider, they may allow you to maybe double the amount or increase the amount by 50%, right? So that's accidental death rider. Usually it's not very costly because the probability of accident related death may not be very high. So it's purely from accidents, not from illnesses, purely from accidents, right? So, and that may require autopsy and those things, right? So accidental death rider is that. So usually it's a very low cost rider, so it's recommended to add that. So as an example, $250,000 whole life policy is a rider which doubles her death benefit for accidental death. So in case of death, it becomes $500,000, right? So that is the example of accidental death rider.
Okay.
Yeah. Yeah. Apnaji, you're following that? Are you clear?
Yes.
Okay, good. Okay. Guaranteed insurability benefit rider. So this basically means that you are guaranteed to if you want to buy additional life insurance coverage in future, it's guaranteed to you, meaning that you do not have to provide proof of insurability. So you may have bought a policy when you're 30 years and you're having this rider. So at the age of 50 years, even if you have diabetes or got into some other health issue or had heart attack or something, it does not matter. You can buy additional coverage without having to go through the proof of insurability. So you do not have to go through the health check and questionnaire again, right? So that is called guaranteed insurability benefit rider.
Okay, got it.
Okay. So those are the riders. These are all applicable after death, right? And supplementary benefits are what? These are applicable before death, right? So you can. So these are examples like sometimes accelerated death benefits. So so if certain conditions are met, the insurance company will pay out a portion of the death benefit prior to death of the life insured. So like you're taking a policy of $300,000, and because a certain situation occurred, usually like very severe illness and stuff, you may be able to get something from that. You need some money. You do not rather than leaving everything for your beneficiary, you want to use some money during your lifetime, in your poor health situation. So this allows basically that. So which are examples of that one? So first situation will be terminal illness benefit. So some illness where the doctor is giving a diagnosis that the death may occur within a certain period of time, say 24 months or something, right? So in that case, you may be able to apply and get some portion of that benefit. So usually it's restricted to a maximum amount, say 25% or 75%. So meaning you can draw only up to that much percentage of the death benefit.
Got it.
So that's the TI benefit. Of course, it is very useful because if some situation like terminal illness happens, that may mean a lot of expenses and a lot of certain things come on you, and obviously if I know that I'm going to live only for next 12 months, I want to maximize whatever I can do during that period. I may want to go for one last vacation or something, right, with the family. So this is all benefit related to that, right? Then dread disease benefit. So this one is mainly about critical illness. How many of you have a critical illness coverage? Anyone has experience with that coverage? What is critical illness benefit or insurance? Anand bhai, any idea?
Yeah, just give me 1 second. I'm just gonna.
Hello?
Hello?
Yeah, it's like anything like for any emergency,
Yep.
like sudden emergency, anything, accidents or heart attack or anything like that.
Yeah. So
It's also Sandeep bhai, like when you have critical illness policy, isn't it true that that policy, that insurance policy will pay off, if there are any outstanding balances, from the loan, should the borrower be diagnosed with, something critical. So basically, that portion is covered under the critical illness policy. So if something has to occur which is detrimental to the health of the insured, the critical illness policy will then kick in and they'll cover basically everything.
no,
And then
no, not everything. It doesn't work like that. So basically, like see, critical illness insurance. So there's a list of critical illnesses which are like severe illnesses. There's a list of many companies have a list of 25 or 26. Earlier it used to be 4, and they kept on adding. So right now standard is around 25 illnesses. Is a list, is a predetermined list.
yeah,
So if you're taking this illness, this insurance policy,
yeah,
and one of those specific illnesses occur, in that case, that you get the full lump sum payment. So as an example, I may have taken $100,000 insurance, critical illness
yeah,
insurance, and something like if I was detected with one of those 25 illnesses, that means the $100,000 cash payment will come to me. So it
okay,
is different from the death. Like, I'm getting that upon
yeah,
detection of my illness, provided that I survive 30 days from the detection of illness. If
yeah,
something
okay,
was detected and I passed away within 30 days, this is not payable. Okay. So that is called critical illness insurance. Why is it useful? Like, for example, in Canada, you may get, the government health hospitalization benefits and drugs and everything. But then there's many other things you're suffering because like you're not able to do the job, you're not able to go back to work for some time. Like your spouse may have to take a break from work and everything. So a lot of disruption occurs, and it becomes very expensive, right? So critical illness
yeah,
is saving you from that situation. Okay.
right,
So that is the use of critical illness insurance. We'll learn a little bit more details on this thing after, when we are learning about the accidental and sickness module, A&S module. Okay. So, but
right,
that's the high level meaning. So where is it coming in the life insurance? Is that this can be used as a supplementary benefit in case of life insurance. So you can take a plain life insurance policy. On top of that, you can add a feature which will be which will be giving you an additional lump sum payment in case there's a critical illness detected. Okay. So the DD benefit is usually paid out as a lump sum once the life insured has survived for a specified period of time after the diagnosis, such as 30 days. Because it is an acceleration of the death benefit, it is not taxable. Okay. So that is the key feature here.
got it.
So Scott has $500,000 whole life insurance policy that includes a $100,000 dead disease benefit. He recently suffered a stroke that has left him almost fully paralyzed. Provided that he survives at least 30 days following the stroke, he can apply to receive the DD benefit of $100,000.
Got it.
Okay.
Yeah.
Okay. Accidental dismemberment benefit, as the name suggests, if the dismemberment of a limb is occurring because of an accident, right? You get a benefit for that, and that's accident. So like usually it's like specific body part or body function. So like these are like list. If you death, of course, 100%. But if you lose both hands, your both eyes, one hand, one foot, one hand, the entire side of one eye, then all these cases you get 100%. If you lose one arm or one leg, you get 75%. If you lose speech or hearing in both ears, 50%. Hearing in one ear, 16 and 2/3%, and that way, right? So basically, it is related to your dismemberment or loss of function of your body parts.
Got it.
Okay.
Yep.
Right. Now, waiver of premium. Waiver of premium is what? Like, if a certain situation occurs, then you may not have to pay the premium any further. Of course, you're paying an additional cost upfront for that. But if a situation like that occurs, you may not have to pay the premium. So let's take an example. So if the life insured, like I have taken a life insurance policy of $500,000 and I become disabled, okay, and I'm disabled for a continuous period, maybe a year or longer, then I do not have to pay the premium during my disability period.
Okay.
Okay, so that basically is the benefit there. That like if I will become disabled, it's assuming that my income will be suffering. So if I have this rider, this benefit, I do not have to continue to pay the premium for that duration. Similarly, parent and payer waiver benefit will be what? So for example, I'm contributing to a policy for my child, and if I pass away, obviously my child does not have means to continue to pay that. So this basically is allowing that if the parent or the payer of the policy he has passed away, then the requirement for the premium for the policy will be waived, so that the child does not have to pay the policy till his own maturity. So if the life insurance is a child, some policies will state the premiums will be waived until that child reaches a specific age, 18, 21, or 25. So that is like insurance company will say that, okay, the child till the time the child has become an adult, he will not have to pay anything. Okay, so that is
Got it.
parent or payer waiver benefit. Okay. So using riders and supplementary benefits to customize coverage. So rather than buying one policy for death, another policy for dismemberment, or third policy for critical illness, if you try and combine these things, usually the cost will be much better, right? So you can use the riders and supplementary benefits to give a cost-effective solution to the customer. So you can keep the cost low, and the value will be increased. Like you are covering more stuff in that, right? Yeah. Okay, so and the differences. So from company to company, there may be some differences. So like these are like general principles, but there may be some minor differences between different companies.
Got it.
So we understood the riders and supplementary benefit. We are clear about those terms.
Yeah.
Perfect. Ankur, you're clear? Ankur? Okay, I think you lost me. I dropped it off his call. Okay, no problem. Apaji, you're clear about that?
Yes.
Okay, perfect. So we're done with one more chapter. Let's look at this chapter and we'll conclude in about 15 minutes. Okay.
Okay.
So this chapter is about group life insurance. Apnaji, what do you mean by group life insurance? What is your understanding?
Group life insurance is like in a company, some people they are insured in a group, like dental insurance or eye insurance or any medical insurance. So they buy insurance in a group.
So partially correct. So group it means like you're buying in a group, right? So like it can be a company, it can be association. So like the company is buying for all those employees, or an association maybe buying for its members. So group insurance can be of two kinds. So one is the life insurance, which is related to the life of the members, and the other one is group health and dental, which is part of the accidental and sickness. Right.
Okay.
So right now
Yes.
we are covering only life insurance. So this topic is about group life insurance. The one that you mentioned, Apnaji, where like dental and health and those things, that is part of the accidental sickness insurance discussion.
Okay. Okay.
And a group can usually like they take policy for both, so they take policy for the life of their members, and they may also take the policy for health and dental, so they may usually take both. Okay.
Sounds good.
So how this works is, so like what constitutes a group? A group can be an employer. It can be just some people from the employer, maybe not everybody. It can be alumni from a specific university. It can be members of an occupational association, like for example, professional engineers of Ontario. They may like take a group policy. Members of a business association, like realtors of Ontario, like they may make an association. They can become a group and they can buy an insurance for their own group members. Members of a retail association. So these are examples of the groups, right? So policy holder, who is the policy holder? Policy holder is the business or organization. They
Yeah.
are the policy holder. Okay. And the contract that you have between the plan sponsor and life insurance company, that is called master contract.
Okay.
So there is no direct contract between the life insured and the insured insurance company. Okay.
Got it.
Group membership. So usually, like for employee, it's very clear. Like people who are on the payroll, and they may have been around for certain months, like 3 months, 6 months. Usually, like that's kind of duration. If it is a membership association like Chamber of Commerce or an association, they need to be a current member of that. So like that organization will clarify how you exactly confirm who are part of the member of the group, right?
Yeah.
And premium usually is so this is based on the makeup of the group as a whole. So it's not specific for the individual. So it's like the insurance company is treating all the people of the group as similar to each other, right? So everybody may get charged, as an example, 20 cents for $1,000 coverage. It doesn't
Got it.
matter whether guy was 30 year or one was 50 year. Does not matter. They all get charged the same rate. So it may benefit some people. It may not benefit some people, right? Some people who are younger, they actually might have been able to get a little bit lesser price outside, and somebody higher may be benefiting because they're getting a little lesser price from the market. Okay. And tracks treatment of employer like a company, for example, they may be able to deduct those costs as business expense. But as far as the employee is concerned, employee, they have to pay tax on this one. So while the employer may pay, for example, $100 they may pay every month for my coverage, but that $100 is considered now a taxable benefit for me, and I may have to pay tax on that as per my that will get added to my income, and I'll have to pay tax on that, right? And the reason for that one is that if you are paying tax upfront, then the benefit will be tax free. If you are not paying tax upfront, then the benefit will become payable. So it is better to pay the tax upfront on the premium. Okay, good so far.
Okay. Got it. Got it.
Okay, good. So there are a few terms here in the the group insurance coverage. So one is earnings multiple, meaning that for example, if Anand is earning $110,000 and Apna is earning $70,000, so now your coverage, the company will say that it will be how a certain multiple of your own earning. So it may be, let's say, 5 times the earning. So Anand will be covered now 5 times 110, whereas Apna will be covered 5 times $70,000, right? So it's multiple of your earnings. Flat rate would mean what? Irrespective of how much you are earning, everybody is paying. Everybody's benefiting the same amount. Say $250,000 for everyone, irrespective of whatever is your salary or whenever you join. Third one is length of service, meaning that it may change or it may vary based on how many years you have stayed with that organization, right? And combination, meaning like it can be like taking different giving different weightage for two different things. Okay. So those are the kind of things which can have an impact on the coverage amount for individuals in the group. Okay, and Sorry.
Okay, yeah, got it, Sandeep bhai.
Yeah, yeah. Now, permanent. Okay. So dependent life coverage, meaning that so sometimes like my employer may be very kind and they'll say that I will allow you to take the insurance policy for your dependents as well. So in your family member, like your spouse or children, you can take an additional policy for them as well. Okay, and they do not have to go through
Yeah,
the
got it.
health check, etc. So that's the dependent life coverage. Usually dependent will be who, like usually the spouse or common law partner, and children till the time that they are adult, or they can define 18 year, 19 year, whatever. It's like, children who are depending on you and the spouse, they can be part of this group policy. Okay. Death benefit amount is usually quite modest compared to the coverage on the member's own life. So usually, like, it's 2 times, 3 times, 4 times of your annual earning. It's not like millions of dollars usually. Okay. And yeah, premium for dependent life insurance are usually the same for each group plan member, regardless of his age or number of his dependents. That's very important. Usually, if your age is higher, you'll pay higher premium. But in the group case, you're paying the
Yeah.
similar premium for everyone.
Okay, got it. Yeah.
Okay. Survivor income benefits. Yeah. Accidental death and dismemberment is similar to the rider that we talked about in the last class, or the benefit actually, right? So same concept applies here as well. You can get some supplementary benefit for accidental death and
Yeah.
dismemberment, right?
Yeah.
Okay, what else? QA I'm not going to read. Okay, so what is happening once I'm leaving the organization? What happens to my insurance policy? So typically the organization would cancel that, but you will have 30 days time for transition of that coverage. You may want to tell the insurance company that you want to continue the coverage, and you will. After that time, the contract will become between you and the insurance company. So the your relation with the employer is finished. Now the contract becomes between you and the insurance company. Okay. So but you can usually carry that policy for future.
Got it. Got it.
Okay. um Replacement contract, we'll read about this one in the ethics chapter. Ethics modules. I'll not go there much. Okay, do you understand what is the group creditor insurance? I'll explain to you. So Apnaji, you have bought a house in the past, right? Okay, she's not there. Okay, I'm right.
Yeah. Yes, sir.
Okay, so what happens that, like, for example, when you're buying a house,
Yeah.
you're taking a loan from the bank. So you may have taken an
Correct.
existing
Correct.
loan from the bank, right?
Yeah. Yeah.
Now, the bank is worried about what happens to their money if something happens to you, right?
Right.
So
Yeah.
what they will do is that they will offer you, or they will ask you whether they want to take an insurance coverage. So
Yeah.
if something happens to you, your family does not have to worry about the payment to the bank, and
Yeah.
the insurance policy will pay to the bank for the money that is owed to them.
Right. Right.
So that is creditor. Like, the bank is the creditor to you, and
Creditor
they
insurance. Yeah.
yeah, and they would have bought a policy, or they would be offering to all the creditors, also all the borrowers,
Yeah.
the insurance policy, and
Yeah.
that is the group creditor insurance, right?
Correct. Yeah.
So yeah, and yeah, so these are some of the terms and conditions. Like, it's not mandatory for them to buy from the bank itself. You can buy for somebody else as well. Okay.
Okay.
And you can cancel that. You have coverage cancellation rights and those things, right?
Yeah. Yeah.
Yeah. If the coverage is declined, you have to yeah, notify the company, the bank, and things,
Yeah.
right?
Yeah.
So, yeah.
Yeah.
Yeah, so that's the thing. And so usually the death benefit is limited, because, like, it's just paying to the bank whatever amount is outstanding to them.
Yeah.
and you're not getting anything in your pocket. The family is not getting anything in the
It'll all
pocket.
go to the bank.
All goes to the bank. Yeah.
Yeah.
So it's not considered to be very good, right?
Right.
And premium usually is higher. That's been what we have
Higher
seen.
premiums. Yeah.
Yeah, so it's not very favored. People who are not much aware, they go with that. But if somebody's aware, they would want to stay away from that, and they'll go and buy private insurance as against going to the bank for that
Yeah.
risk coverage. So that is the group later insurance. Yeah, there's some comparison and advantage disadvantage. So Anand bhai, if you go and just speak to someone and then you ask them whether they have life insurance or they want life insurance, and they tell you that I'm working with this company, and the company is already giving me life insurance, so I do not need the life insurance further from you, right? So if they say, what is the answer for them? So answer is here. So that you can tell them that while you may have a group life insurance, there are certain disadvantages of that life insurance. So what is that? First one is people in very good health will pay the same premium as the rest of the group. So somebody age of 30 and somebody age of 60, they may be paying the same amount, meaning the
Same
people who are in the age of 30, they are paying higher than what they should have paid if they are doing on their own, right?
Yeah. They're paying unnecessary, basically.
Yeah, that's very right. Second one is that the employer controls the plan. They can make changes without consulting the group members. You may not even know, right? Or you may know later. The amount of
Yeah.
coverage may not be what the plan member needs. So they may offer you 3 times earning or 5 times earning, and you may need $1 million. So there's a mismatch of your need and the offered coverage. And
Offered.
the premiums of individual coverage upon conversion are not guaranteed, meaning that if you are converting from the group, like you're leaving the group and you're converting that to yourself, the premium may not be guaranteed, so you may actually be paying a little higher, right?
Yeah.
So yeah, and employer paid premiums are a taxable benefit. That's not a very serious one, but it's like it's just counting that as a negative. Okay. So these
Right.
are some of the disadvantages. So like you can tell them basically that the insurance coverage from the group that they got may not be sufficient, so they should really take a look at outside coverage as well, or supplementary coverage.
Yes. Correct. Correct.
Okay, so that's the group life insurance. Okay, so we have covered 2 chapters. So first one was the riders and supplementary benefit, and second one was the this one, the group life insurance.
Group life insurance.
Are we clear about these concepts?
Yeah.
Okay, good. Apnaji, are you clear?
Yes.
अपना जी समझ में आ गया ना?
हाँ.
हाँ,
Hello.
ठीक है, हाँ, बड़ी
Yeah.
अच्छी बात है. तो फिर ऐसा करते हैं कि we'll stop it here because like there are not many people are there. So these 2 chapters we have done, and then that leaves us probably with I think 2 more chapters. So we'll try and complete that with the rest of the group very soon. So we have to discuss about the taxation, and then we have to discuss about the business insurance, and last one is application and underwriting. So 3 chapters are remaining on this in this book. That's it. That's it.
Okay. Sounds good.
Okay.
Sounds good. And then it'll again be next Wednesday, right?
I think I may try to schedule something a bit earlier. I'll speak with other people, and if they're available, we can try to do an advanced one. Worst case, it will be next Wednesday for sure.
Okay. Okay. Yeah, that'll be good.
Okay, very good. So in the meantime, please try to go through what we discussed, and also if you prefer to watch the video, you have the link for that. You have the materials in the book, the Oliver's class as well. So go ahead and do that.
Yeah.
Okay. So again, please remember that just by having clarity of this knowledge on these things is going to be very beneficial as a for career and for your business. So I think the effort is well spent if you're doing this. Okay.
We can actually take up a topic, and each one can present for, let's say, 5 minutes. Like, so next class you can take the training for the next 2 chapters, and then each one of us can pick one particular topic, and then give a brief presentation on that one.
Okay. Yeah. Yeah. Sounds good. Sounds good. We can do that. Well, yeah. But please do review the materials. Okay, everyone.
Yes, sir.
Perfect.
Thank you very much, Sandeep bhai.
Thank you. Thank you, everybody.
All
Okay,
right.
Rajiv. Yeah.
Have a good night.
Cheers. Bye.
Good night.
Good night.